I've been trading actively for over 10 years now. Um, and I have a master's in industrial engineering from LSU in Baton Rouge and in finance from the London School of Economics. So let's get underway. Just one sec before okay, so yeah, I just had some technical issues there. So just by way of formality, let me put up this risk warning and disclaimer. So there are actually two of them. So the first one is from Trade with Precision and the second one is from Nadex. I'll leave each one up for about 30 seconds or so. Please have a quick read through. In brief, we provide education only, so we do not give financial advice. Trading the markets can be risky and it is not suitable for everyone. And if in doubt, you should seek independent professional advice. I'd like to highlight that by continuing with this webinar, you are indicating your agreement with its contents. So I'll leave this one for about 30 seconds or so. And this is a second one from Nadex. So if you can please have a read through that, and I'll leave it up for 30 seconds as well. Okay, so looks like we have a good crowd here today, and we have quite a lot of material to cover. So let's get started. Now, I have a question at the outset, and this is from Benjamin, and he asks, he came in late, and will this webinar be recorded? Yes, this webinar is being recorded, so it will be posted on the website, as with all other Nadex webinars. And Benjamin, you're not late because we haven't actually gotten into the meat of anything. We've just started the webinar. So yeah, welcome to the webinar. So since this webinar is brought to you by a joint partnership of Nadex with Trade with Precision, I'll just take a few minutes here to introduce both companies. So Nadex is actually a derivatives exchange and they're subject to regulatory oversight by the CFTC. So this is a regulated industry for your protection. Nadex was formed in 2007, but is part of a much larger derivatives organization known as the IG Group. Nadex operations are run out of Chicago, so which is the hub of the futures and options market in the US, and if not the world. All contracts that we'll be discussing today are cash settled, so there's no risk of having a mountain of corn delivered to your front yard. And there are over 25 global markets which you can trade with two unique contracts, so binary options and spreads. Now, Trade with Precision was created in 2006 by Nick McDonald as a provider of trading education for retail traders. So we are an international team of traders that provide training for some major brands of exchanges and brokers around the globe. So we teamed up with Nadex to bring you some specialized education around their products. So Trade with Precision is a company that is run by traders, for traders, and we are specialists in trading strategy education. So, and you can trade Nadex products on multiple devices, including your smartphone and tablet, of course, in addition to your PC. So let's come to the agenda for today. And well, to begin with, first of all, some of you may be thinking, why trade commodities? So I'll give you an introduction to these markets in energy and precious metals. We'll talk through some trading strategies today to help you understand how to take advantage of the opportunities in these markets. And by the end of the session, you'll understand why a trading strategy is so important. And I'll also provide you some examples of technical strategy as well as fundamental strategy. So both technical strategy as well as fundamental strategy. Then we'll wrap up and we'll have a few more details on how you can take your trading to the next level with Nadex. Also, since this is a 2-hour webinar, So what we'll do is we'll take a break for around 5 minutes at the 1 hour mark, and that will give you some time to get some fresh air or make a cup of coffee or something along those lines. So just at the top of the hour, we'll take a break for around 5 minutes or so. Right. So like I said earlier, the question you may be thinking is why trade commodities? So what's so great about them? So let's find out. So what is a commodity? So well, a commodity is a raw material or an agricultural product. So commodities satisfy our basic wants and needs. We use them. We use these products basically in various ways in our everyday lives, in one form or the other. So these products are global in scope and are produced in various places around the world, and they're heavily traded, either as exports or as imports between countries. So the general categories of commodities are, well, energies, metals, agriculture, foodstuffs, and livestock. And for this session, we will focus on energies and metals. Right. So these products can be bought or sold on an open exchange in specified quantities between the producer and the broker. However, with Nadex contracts, we're only interested in the speculative paper transaction. So no actual commodities are ever exchanged via a Nadex contract. Now, supply and demand are usually what drives the prices for commodities. So this includes metals and energy, and of course, economic factors and political factors which affect global trade, and thus they affect the supply and demand relationship. So quite simply put, and I know this is very basic, as demand increases and supply increases, prices rise for anything. And conversely, as supply increases and demand decreases, prices fall. So if there's more supply and less demand, then prices fall. And if there's more demand and less supply, then prices increase. So for example, this is what we are seeing right now with oil over the past few months. So demand has not really increased dramatically. It's been more or less constant. But what's happened is Iran has come into the market, and OPEC has not really cut back on production levels. So what that's done is it's created a flood of supply, and the U.S. Sort of reserves of oil and the U.S. stockpiles of oil are quite high. So what that's done in the world market is there is a constant demand and there is an abundance of supply, and therefore we see what's happening with oil prices. Oil prices are dropping, and of course weak demand coming out of China as well, because China numbers, as we know, since the beginning of this year have been quite soft. So metals and energy commodities usually exhibit quite strong trends. Now, prices rise or they decline for relatively long periods of time, and what this does is this translates into relatively very good trading opportunities. So most metals, for instance, so if you look at most metal charts and if you look at the dailies or the weeklies, you'll see they were in a downtrend. So they were in a downtrend from like 2011. So some parts of 2011, beginning of 2011 in most cases, almost till December last year. But now if you look at them, so from Jan this year, for example, gold, platinum, copper, all of these metals, they're all trending up from Jan this year. Oil, on the other hand, which is of course something that's an energy related commodity, oil has been declining, as we all know, and I just spoke about some of the reasons why. And this kind of price action basically, like I said, gives us very good trade setups. So as traders, our job is to find high probability trading opportunities from charts. So whether it be daily charts or weekly charts or hourly charts. And this is something we can obviously do with Nadex contracts. Now, one thing, if for those of you who are unfamiliar with this, we can trade contracts from 5 minutes up to a week, provided obviously we have a viable strategy and obviously the right setup on the charts. So a couple of charts here on natural gas, and both these charts here are basically their daily charts, and what they show is some very nice multi-day and multi-week moves excuse me, in both directions, long and short. So let's focus on the chart on the left, that is the downtrend. So just by looking at the price action, we can see prices rally back into the sell zone, and this creates some great opportunities to look for using the trend flow strategy. And we of course teach the trend flow strategy in the Nadex advanced course. So although the moving averages are not drawn here, after every rally, what we see is we see bearish setup candles in the moving average equilibrium zone, and this signals the next move lower. So if we did have the moving averages drawn here, they would be pointing down in the correct order, fanning, and with good separation between them. Now, if some of you don't understand some of the things that I've just talked about, well, one thing, of course, is it would be helpful if you attended the advanced classes where we actually talk about the strategies in a lot more detail. But nonetheless, I'll make it easy and I'll just try to explain some of these concepts as we go along. So it will become clearer as the webinar progresses as well. So moving right along, here's another chart, and this one's on crude oil, and this is in an 8-hour time frame, and you can see some great looking trends. So nice price action, and this is an uptrend obviously, and this is on the left, and the downtrend on the right, and there's pullbacks and rallies, and that provides some obvious entry points either to go long or to go short. So and these are 2-hour charts of silver. So again, on the left, you have a beautiful downtrend with consistent selling pressure, which makes it more predictable. So these are the kind of charts we want to be trading off, basically using trend-based strategies. Now, this chart on the right here, so it's obviously not in a trend, it's in a range. So since Nadex contracts are a fixed type of contract, a fixed risk type of contract. So your reward and risk is fixed in the Nadex contract. They're actually great for trading trends, but they're also nice for trading ranges, unlike if you were trading the underlying market. And so obviously you see this chart on the right of the screen, which is ranging, and you can basically trade this chart around key support and resistance levels and basically play the bounce with a fixed short-term binary. So you can play the bounce of this, you can play the bounce of this, you can play the bounce of this, and you can do this using a fixed short-term binary. And we'll see some of this in some of the examples that we bring up later on in this webinar. So now that we've seen some charts at work, let's see how we can take advantage of these opportunities for a potential profit. So if you're new to Nadex, the advantage of these unique sort of option contracts is that you can trade multiple markets, and you can do that from a single account. So you can trade commodities as well as foreign currency. And basically there are 2 types of contracts to choose from. So you have binary options and you have spreads, and they come in a variety of strike prices and spread ranges, and both of these instruments have some unique characteristics that can be used in different markets for different purposes. So let's briefly take a look at these trading instruments to make sure that everybody on this session is on board and understands the basics of what we're talking about. So by the way, and just like to mention here, if you haven't already, there's another webinar, and this webinar is again open to everybody. So it's open to both Nadex members and non-members. It's called Introduction to Binary Options, and again, it's run every month. I actually ran one last week, and so it would be good if you attended that webinar, because you'll understand some of the terms and concepts that I'm using here. And I'll try not to let that happen, in the sense that so for those of you not attended the webinar, I'll try to make sure that they're not really disadvantaged. But it would be good if you went back, and you can always review the recording, and you can also sign up for this webinar, and we actually run them every one, like I said. So I have a question here, and this question's from Linda, and she asks, can you get a copy of the recording? And yes, of course you can. And so what it is there's a library of past webinars on the Nadex website, and we're actually adding to this library every week. So you can go to the website and have a look, and some of these videos maybe for Nadex members only, but so if you're already a member, so no issues, you can just jump on the website and have a quiz. But if not, you might want to consider becoming a Nadex member. In any case, let's take a high-level overview to get everyone on the same page regarding binary options and what they're all about. So So, and I have a comment from Jeffrey, who says, excited to see what everyone is going to learn. Thanks, Jeffrey. And Jeffrey is from the Nadex in Chicago, listening in. Okay, so in any case, let's take a high-level overview to get everyone on the same page regarding binary options and what they're all about. So binaries are pretty straightforward. They're a limited risk derivative. And they are similar to a standardized option. So the main difference is that they're based on a simple true or false proposition, and they have short expiries. So I have a question here from Yehuda, who asked, what is your focus tonight, binaries or spread? Well, Yehuda, my focus tonight is actually strategies, and strategies that can be applied on obviously both binaries and spreads. So the focus tonight is not binaries and spreads. We actually ran a webinar, and we run a webinar on binaries, and we have run a webinar on spreads. So introduction to binaries and spreads. So tonight we will be actually talking about both binaries, and we'll be talking about spreads, and we'll be talking first of all in general terms on the strategies and the strategies that you can apply to binaries and spreads. And as we go later in the webinar and deeper in the webinar, you'll see that we will be getting deeper and talking more specifically around opportunities on both binaries and both spreads related to the energies and the metals markets. So energies and metals commodities being the underlying. So we'll discuss that as we go along. So yes, so tonight we're talking about both binaries and we're talking about spreads. So as I said, binaries are pretty straightforward. They're limited risk, and they're similar to a standardized option. So they're based on a true-false proposition. And what they do is they offer you a very intuitive way to trade various markets, and they do so. And this is important, guys, with a relatively small amount of collateral or capital. And you can trade options with expiries ranging from, say, 5 minutes up to 1 week. So, and what beauty of this is that it allows somebody who's relatively new to trading to trade the smaller time frames. And trading the smaller time frames, guys, can be difficult if you're trading the underlying market. But if you're trading binaries, because of their fixed risk reward nature, they enforce certain risk management principles on you, and so you can trade the relatively smaller time frames, even if you're a beginner trader, safely using binaries. And that's one of the biggest beauties and advantages of binaries. So the other thing is, whether you're a day trader or swing trader, you can make binaries work for you. So it doesn't really matter. Why? Because binaries, well, they come in expiries from 5 minutes up to 24 hours. Spreads little bit different, because spreads have expiries less than 24 hours usually. So spreads work better for people who are more looking at shorter time frames. So intraday up to sort of 24 hours is what suits spreads, suits those kind of traders. Now, some of the benefits, obviously, I've just spoken about. Other benefits, obviously, are quite obvious. So, when you're trading binaries, you're trading with a limited risk scenario. Secondly, collateral or capital requirements are very low. Remember, most contracts can be traded for under $100. So, using binaries, you actually gain good access to trading opportunities in either volatile markets or flat markets, and binaries actually offer you a very good reward to risk setups. So I just talked a lot about binaries. The other contract obviously is a spread, and spreads are a simple derivative, and they have a built-in floor and a ceiling price, and that this corresponds to the underlying asset price. So if, for those of you who are familiar with standard options, what is a spread? A spread is simply a prepackaged vertical spread, so which you can trade either long or short. So the spread, so basically it's like all it is like it's prepackaged, so you don't have to trade multiple contracts. You just, with one contract, you're basically trading a vertical spread, and that's a spread that's available on the Nadex platform. So that's the beauty of it. So the spread range, basically the levels and the low and the high points are defined, and this is the low and high points which the contract may settle relative to the underlying market price. And these low and high points are basically, they're called the floor and the ceiling respectively. And like binaries, the important thing is you know your maximum potential loss or your profit as well on each trade before you place any of your capital at risk. So like binaries, spreads are based on the underlying markets, such as crude or natural gas, or maybe a precious metal, and they're available to trade. Well, they're available to trade forex and the index markets as well, though that's not our focus tonight. Now, some of the benefits of trading spreads are, first of all, if you have a leveraged contract, which if you so choose, you're looking to hedge, then you can hedge that. So you can, if you have a so you have if you have a futures position and if you have a long futures position and you're looking to hedge that, or long or short actually, you can, if you have a futures position and you're looking to hedge that futures position, then you can hedge that futures position using a spread. So on using a Nadex spread, you can actually hedge a futures position that you might have open. And this, secondly, of course, the biggest benefit, and I've talked a little bit about this, is this is a limited risk contract. So your downside risk, guys, your downside risk is capped, it's protected, and the beauty is that it's protected without the need for a traditional stop loss. So, and of course, contracts, all these contracts are cash settled, so there's no margin to consider, and like your risk is limited, like I said. So your risk is again limited to the either your buy price or the collateral that you place when you sell. And of course, the other thing is you can trade these contracts with a fairly small capital outlay. Now, and like I said, if you like to intraday trade, then spreads are a great vehicle to do so. And for binaries, of course, you have expiries ranging from 5 minutes up to a week. And for spreads, the maximum is 24 hours, like I said earlier. So I have a question here from Hamish on how do you hedge using spreads. So, well, I don't want to get into the details, but without getting into the details, basically, just as I said earlier, if you're long a futures contract, you hedge using a vertical bear spread, or in other words, you sell an appropriate Nadex spread. And conversely, if you're short a futures contract, you can hedge basically using a vertical bull spread, or in other words, buy an appropriate Nadex spread. So I hope that answers your question, Hamish. So moving right along, the idea here is by utilizing a Nadex contract to trade commodities, you can create good trading opportunities whether on an intraday basis or on a swing basis. Now, if the markets are moving well, then there are more than likely trading opportunities using the trend flow and momentum breakout strategies, which of course we teach in the advanced course. And Nadex contracts actually set up quite well with these two strategies. However, if the markets are stuck in a range, and since Nadex contracts have a fixed risk, there can be great opportunities during this ranging days as well. Now, I wouldn't normally advise people to trade ranging markets using the underlying, but with Nadex contracts or with binaries and with spreads, it's possible to effectively trade ranging markets, and we'll see how in some of the later slides. So, and we can do this basically using what is known as a clustering trade strategy, and we teach this in some of the webinars, and one can basically, using the strategy, find high probability setups when the markets are ranging. So let's look at some optimal setups for trading binary options and spreads. So before we get underway, so a couple of concepts to understand when you're trading Nadex contracts related to intraday or swing positions. So first and foremost, the time frame of the trade setup can and will impact which contract you choose to trade, and we'll see how to do this in some of the later slides. So, for example, excuse me, binary contracts are suitable for both styles, since binaries, like I said earlier, are available in weekly expiries and all the way down to 5 minutes. And each binary contract will have multiple choices with reasonable expiries and bid and strike prices. So they'll have reasonable expiries and reasonable strike prices to suit your trade setup based on the reward to risk characteristics. Again, when we use some of the examples, some of these concepts will become a lot clearer. So, for instance, we did a webinar on introduction to binaries last week, and those of you who were there will recall I discussed in quite a lot of detail in last week's webinar, how to manage or how to trade binaries and how to look for an appropriate contract using the risk-reward characteristics which matches your trade setup. Now, spreads are a little different. They are only available for intraday trading, so not really for swing trading. But because basically there are no multi-day or weekly expiries, so you can certainly trade a daily contract and you can hold it overnight for a 24-hour period, but that would be your maximum trade duration. Now, I have a question here from Min, and he asks which contracts are better to trade, and the answer is it actually depends. It depends on the trade setup you're using. It depends on your anticipated profit target. It depends on the duration of the trade, and it depends on whether you want to risk an all or nothing payout or you prefer a variable payout structure. So all of these factors. So both are good products. So both binary options and spreads are good products, but it depends on the situation and it depends on what your objective is. So, and we look at how to do this later on in this webinar using examples, and some of this will become clearer then. So, so okay, so I have a question from Ike who asks trade and whose money do I get when I win a trade? I'm not clear what your question is, Ike. It's a trade and whose money do I? So the way it works with a binary contract, for instance, is when you buy a contract, you pay for a contract. So let's say you buy a contract for $55. So you pay $55 to buy the contract, and on the other side of the transaction, you have a person who's selling the contract, and the person who sells the contract needs to put up the collateral for the price that he's selling at. So if you're buying at 55, the other person is selling at 45, because the binaries are always it's a 0 to 100 proposition. So what that person does is that person puts up the $45, you put up the $55, that makes the $100, and the exchange, which is Nadex, holds the $100. So depending on the outcome of the trade, Nadex obviously pays out the person net, of course, of costs, which are commissions and charges and so forth. And I hope that clarifies your question. Um, so here we see two different charts. So on the left is a trending chart, and on the right we have a chart that is ranging, and we also see the spread contract details, and we also see the binary contract details just below the charts. Now, spreads and binaries are good for trading, range trading, especially when the support and resistance levels match. This is important, guys. So they're good for range trading when the support and resistance levels match the floor and ceiling price of either the spread or the binary contract. So using this example, let's look at our alternative. So using spreads, for instance, first, in the first example, we have a pullback into the moving averages, and we would be looking to go long. So right here, we have a pullback into the moving averages, and we're looking to go long. Or in other words, we're looking to buy a spread, right? And I'm just talking about spreads for the moment. So we would be looking to enter at or close to the floor of the spread, and that's important. So when we're trading a spread, what we want to do is we want to enter as close to the floor as possible when going long, and when going short we want to enter as close to the ceiling as possible, so because that maximizes our profit. But the thing is that even though we have a good trade setup, this doesn't necessarily mean that every time we have a good trade setup, we will have a spread that fix exactly into our trading scenario. And so we need to pay a lot of attention to the reward to risk of payout of the trade. Now, let's look at our alternatives with binaries. Now, once you've done your risk reward analysis, and you're more than likely, so 9 times out of 10, or if I may be so bold as to say, when 10 times out of 10, you will actually find a binary with a strike price that fits your trade setup scenario. So binary contracts will be applicable virtually all of the time, and spreads, well, they may not be applicable all the time, but they will be applicable sometimes. So that's basically one difference between binaries and spreads. So let's look at the second example of the ranging market here. And what we are interested in doing is we are interested in fading the range of support and resistance levels. So when price goes to a support level, we want to fade that move back up here, or when a price goes to resistance level, we want to fade that move back down there. So that's how we want to trade our ranges. So what we want to be looking at also is an overextension from the moving averages, which you see here. So the moving averages are there and prices are there. So fair bit of overextension from the moving averages there. And we want to see an overextension into a key support or resistance level, which you have right here. So prices are pulled to a support resistance level, bounced off, and are still overextended. So it's likely that prices will snap back to the moving averages and probably go back and retest this level of resistance if, of course, the price keeps ranging and a new trend does not form. So the one thing I must mention though, and uh, of these two trading techniques, so of trends and ranges, personally my preference is for trading uh, trends rather than ranges. And because at least in my opinion, I think it's a higher probability trade. So there may be people who may disagree with me, and I know there are, and I've had heated discussions on this in the trading community, but I believe it's better to trade a trend rather than a trade. So I'd be looking at chart setups like this rather than this one here. The both are valid and both can be traded using Nadex contracts, provided, of course, you have the proper strategy. Now, I have a question here from Mihir, who asks, can can you please explain why and how boundaries are applicable all the time and spreads only some of the time? Okay, so just I'll go to the next slide, and in the next slide I'll just explain using an example what I just spoke about. So let's look at the setup here on gold, and what we want to do is we want to follow the trend to the short side. So here we see the price action, and it's there's a downtrend, and we want to follow the price action to the short side. So there's a rally back right now, and there's a rally back to the moving averages right there. And as I said earlier, both binaries and spreads are ideal for trading intraday. But as I mentioned, binaries will usually apply to most trade setups. So whereas spreads will apply only when the price is at or around the floor or the ceiling. So as you can see here, like as you can see, simply by the sheer quantity of binary strike prices available, there will be much more reward to risk scenarios to choose from to match whatever trade setup you may be having in the underlying. Whereas on spreads, you have far fewer contracts to choose from, and also the floor to ceiling level, floor and ceiling levels may not provide a optimal risk reward scenario. So here, for instance, we are looking to go short, and we're looking to go short at 1304, and you see the contracts, the spread contracts available. So 1304 is outside the range of most of the contracts. So this contract, for instance, where I'm hovering my mouse right now, is 1305 to 1306, and this one has got a floor and a ceiling of 1305 and 1306 again with different expiries. But so it's outside the range, so not really, doesn't fit in with my trade setup and my trade parameters. Now, one thing we could do is we could actually look at different expiries on these spreads. So on these spreads, we could actually look at different expiries and see if there are alternatives. But in terms of just the slides, just the sort of contracts presented on this slide here, this is a binary only trade setup, and um, when of course we have several binary strike prices to choose from, and that provides us basically a very good risk reward risk scenario. So 1:1 or better. So, and basically here I'm looking to sell because I'm looking to go short, and I'm looking to go short at 1304. So I'm looking to sell, and I'm looking to sell at anything from a price range of $50 up. So anything from 1303, which is slightly out of the money, to something that's more out of the money. So as it gets more out of the money, it obviously becomes we're getting a better price. So our profit potential is improving. Remember, we're selling here. So when we sell at 84, we get $84. When we sell at 75, we get $75. So we're selling here. So I would be willing to sell at anything from 50 up, and obviously with 1303 being the one with the least risk, with the 50% basically probability of success. And as we go up, this ladder here, this price ladder, the probability of success somewhat diminishes. But if our trade setup says that this it's a valid trade, then we just go for it, and we try to maximize the profit potential. And we'll see how to do this using some examples later on in this webinar as well. So the point that I'm trying to make is whether you day trade, or whether you swing trade, or whether you're a trend follower, or whether you're a range trader, and there's basically something everyone with Nadex products. And all of your trade setups basically become, then, like I said earlier, and I've been talking about this quite a lot, is what they become is they become a fixed risk scenario. And the beauty is they become a fixed risk scenario without a traditional stop loss, and with a very good potential reward to risk trade. So remember, for an Nadex option, you get 100 payout if the settlement price is just above the price point. So you don't need a price to move 100 points to maybe get a 1:1 reward to risk, as you would if you were trading an underlying future, or an underlying whatever commodity, or underlying, or or even an option. So you don't need for that to happen. So in the underlying, you actually need the market to move all the way. Here you just need the market to be above the settlement price, and you can get a $100, 100%. So what that does is basically that improves your reward to risk equations dramatically. Now, also, if you haven't taken the Nadex Advanced course, so I just and you don't understand some of the terms that I'm using. So when I mentioned reward is to risk. So one of the things that I'm talking about, basically, I'm talking about is what I'm looking for is how much reward do I get for every dollar that I risk. And the thing is that if you're working with a reward to risk ratio of better than 1:1, so even anything better than 1:1, and even if we are, let's say, a very ordinary trader, so even if you have, let's say, a 50% win rate, then we can still be profitable. We can still be profitable. So why? Because let's do the math here. So let's say you're an average, if on an average your profit on winning trades, let's say, is 1.5:1, and on each of these losing trade is, let's say, 1:1, and you have a win ratio of 50%. So you can still profit 50 cents on the dollar. But on the contrary, if you're risking $1 to make 50 cents, then you need quite a high, or an incredibly high win rate in order to be successful. So, and of course, we can show you how to do this in the advanced course. And again, the advantages of trading Nadex binaries and spreads: two, one, limited risk on each trade, and two, potentially reward to risk much greater than 1:1 on every trade. Now, how do you choose your trade setups and build on a trade idea for yourself? Now that is entirely up to you. But at Trade with Precision, what we do is we use predefined trading strategies, which are predominantly trend-based strategies. So we use these strategies to identify our setups, and we use these to actually trade our own accounts. So these are strategies that you learn in the advanced course, and these strategies are applicable basically to any market on any time frame. And I'll actually discuss one of these strategies in some detail today as well. So a great way to trade commodities in a fixed risk environment, obviously, is with Nadex contracts. And if you decide to follow our strategies, what you're doing is you're basically using proven strategies and methods to standardize your trade entries and exits. Right. So basically, also other thing I'd just like to mention is that it doesn't cost you anything to come along for the advanced course. All you need to do is just open an account with Nadex, or basically become a Nadex member, and you're in. And everything in the advanced course is basically complimentary. It's complimentary from Nadex, and we run this course every other month, and it can really help you with your trading enterprise, basically. So, since we are on the topic of trading strategy, so I'll just give you a little taste of what I'm talking about, so you get the idea. So, like over the last few slides, I've talked quite a bit about strategy and not really explained much. So, let's talk a little bit more about it. So, first of all, you need to understand what a trading strategy is and what it does for you. So, and it's also important to understand what it is not. So, what a trading strategy is not. So, first, let me talk about what it is not. So trading, first of all, trading and trading strategies are not about crystal balls, and they're not about fortune telling or being able to forecast certain specific outcomes, because trading is all about probabilities, and it's about stacking the probabilities in your favor. Now, professional traders are not magicians, they're not prophets, they're not insider trading artists. Uh, and and I mean, anything basically can happen in the markets at any given point in time. So it's not about crystal ball gazing, or it's not about being right every time. Though of course that's what you aim for, but one must accept that one will be wrong at times, and basically the market will do what the market wants to do. So trading basically is all about thinking in probabilities and building those probabilities towards a compelling trading idea or a trading decision. And obviously, what you want to do is you want to be right more often than not, and you want to have a positive risk reward situation or reward to risk situation, and which will then basically make you profitable. So, sum, that's in a nutshell, that's the secret to trading. So nothing in life, of course, is perfect, and neither is trading, and neither are trading strategies. So, but the idea behind utilizing a trading strategy is all about, and I've talked about this a few times, is it's all about stacking the probabilities just slightly in your favor. So what it does is it gives you an edge. It's like, so it's, think of it like it's like tossing a coin, but because you're stacking the probabilities in your favor, you're tossing a coin which is biased. So you do, and obviously, so you'll have more, let's say, heads than tails. And if you have more heads than tails, and even if you bet $1 per trade and you lost $1 per trade, let's say when you were flipping a coin, if it was biased slightly in your favor, you would come out ahead. So the best thing to do is to bias, obviously, the stack the probabilities in your favor, as well as have a reward to risk situation of 1.5:1. So think about this. So think about, if you're flipping a coin, the coin was biased in your favor, A, and B, you got $1.50 payout for every dollar that you lost. Would you not win? Do the math. I mean, you would win. It's mathematically impossible to lose. So I have a question from Yehuda, who asks, any source you would suggest to learn more about charts in general? Yeah, well, there's a lot of course, there's a lot of sources on the web. You can go on the web and you do a search, Google search. There's a lot about charts. But one book I would recommend, and this is quite a standard book on technical analysis, is by a gentleman called Martin Pring. So Martin, Martin, Pring, and Martin Pring has written a few books actually on technical analysis, and there's two. I think there's one which is at an introductory level, and that's one that's more advanced. So you could buy the book. You can just go and check them out. So you might want to, yeah, look at Martin Pring's book is a good reference source for technical trading, I think. Now, in order to build an effective trading decision, what we need to do is, and I've spoken a little bit about this, what we need to do is we need to look for a series of compelling factors to determine if the if a trade idea is worthy of our risk capital. So a trading strategy may basically be comprised of several layers of technical analysis, and in each layer, what we are trying to do is we're analyzing price action to determine what technical factors support our trade idea. Now, we definitely need a specific price point to enter the markets, and this is not something that's general or vague, but it's actually very specific, and it is based on the underlying price action. So we also need our strategy to tell us a precise place to put our stop loss. So we need an entry point, we need a stop loss, or in Nadex terms, what we need is we need to determine our risk on the trade. So we need to have an entry, and we need to determine how much we're going to risk on the trade. And since with Nadex contracts, we obviously don't use stop losses because obviously the risk limits are built into the contract itself. But if you look at the order ticket on the left tells you your maximum loss. So you've calculated your entry point, and you know the maximum loss that you can suffer from the trade, and based on that and knowing that is how you enter into a trade. So, and the third thing, of course, is once we've entered into the trade, we need a plan. We need a plan to manage the trade and to determine our profit targets. And this is not something we do on the fly or by the seat of our pants. So we need to have a plan before we go into the trade. This is going to be my entry. This is going to be my stop loss. So this is going to be my maximum risk. And this is where I'll be looking at taking profits. So you need to have a plan, and that's how you go in and manage the trade as well. So, and of course, this involves properly exiting a position, and we'll talk about some of this in today's webinar. But we actually talk about this quite a lot in some of our other webinars. So, in the introduction to binaries and spreads and introduction to binaries, we actually talk about how to manage the trade in a lot more detail. And those guys are free webinars, so all of you are welcome to come along and join those webinars. Now, the essence of a trading strategy is basically is to build on a trade idea. So the whole thing is so that you can arrive at a conclusive, basically a trading decision. Now, so what is this? This is basically, like I said earlier, it's several layers of technical analysis, and what they do is they stack the probabilities in our favor. Now, you might hear me during the course of this webinar repeating some things, some concepts, some words, some ideas, and there's a reason I'm doing that. The reason I'm doing that is because they are critical and they're key and they're fundamental to your trading success. So that's why I keep doing that. So things like stacking the probabilities in your favor is one such thing. Now, what's a strategy? So if we were to define a strategy, so we can define a strategy as a set of rules that guide our analysis and basically give us an edge for ourselves in the market. And what this edge is, it represents a higher probability of success. So there we go again that P word. So higher probability of success. And basically what it does is it helps to stack the odds in our favor. Now, importantly, and this is very important, guys, and a lot of people who are beginning their trading journey don't recognize this, but it's important to manage our emotions. And a lot of people have written a lot about this. In fact, if you guys want, you might want to check out a book there's a guy called Mark Douglas, and he's written a book called Trading in the Zone, where he talks a lot about managing emotions, and that's a good place to start as well. And what we want to do here is we want to manage our emotions, mostly the two emotions that play a big factor in trading, which is fear and greed. And we want to trade objectively, and we want to trade with logic and with reason. And this is where basically trading discipline comes in. So what we need is we need a strategy to define the rules, and we need discipline. We need discipline to stick to those rules no matter what. So that is basically what we are looking at. And I'm just looking at a question here. So so I have a question from Richard Summers, and he asks, Okay, so do you know if professional traders have algos or spreadsheets built with probability distributions? Look, there are different styles of trading, and one of the what you are referring to is one of the styles of trading is what is known as quantitative trading. So you can trade quantitatively, sorry, and that's as valid as any other method or form of trading or trading strategy. So if you're looking to be a quant or you're looking to trade from a quant angle, and a lot of hedge funds actually trade quantitatively. So yes, you can use algos, and there are things known as HFTs, and HFTs basically trade only of algos, and some of the biggest names in the trading world like Nomura are all HFTs. So, and I don't want to get into a lot of that, but yes, you can trade with algos, and you can trade, but there's a lot of maths that goes into it. So basically, the way you may model the market. So you model the markets using what is known as stochastic differential equations, or Ito calculus, and then that's beyond the scope of today's webinar, so I won't get into that. But the short answer to your question is yes, you can trade using algos. So let's take a look at both. Let me just go back to the previous slide. And what I just wanted to say was I've talked quite a bit about technical strategy, but basically trading can be done with fundamentals as well. So you can have either a technical strategy or a fundamental strategy. And the difference between the two is the technical strategy is basically based on price. And the basic assumption is that all the information relating to the underlying asset is reflected entirely in the price of that asset. Now, so basically the idea being that if you focus on price, then that gives us a good indication of where the market is headed. Now, in the case of a fundamental strategy, what we're looking for is we're looking for all of the non-price related financial information related to that asset. So, and we use this basically to determine future price performance. So this includes things such as, in the case of commodities, we will be looking at things such as supply and demand, and these numbers, especially for energy, like oil prices, and these are released every week for the energy markets, and the market, of course, reacts accordingly, and the prices go up or they go down. Now, as I said earlier, so if price supply is high, prices goes up. If supply is low, then prices rise. Now, the thing is with Nadex contracts, because they're fixed risk contracts, we can actually structure a directional, or if you so choose, even a non-directional trade based on news announcements of these economic events. And in common parlance is just referred to as trading the news. So we'll take a look at both strategies today, and we'll start off here with technical side of things, detailing the critical chart structures that we want to see for optimal trading setups. So we're close to the 1 hour mark. What I'll do is I'll just go through a little bit of this because we're a little bit behind on time, guys, and then we'll take a 5-minute break. So apologies, it's just coming up almost to the hour, so about 4 minutes left of the hour. So let's just go through a few slides, and then at the top of the hour is when we'll take our break. Now, in technical analysis, especially if you have a trading strategy, what we do is, like I spoke about, we use several layers of technical analysis to build on a trading idea. So these layers are basically our ingredients, and we combine these layers or these factors in various proportions, and this is what constitutes our trading strategy. So what are some of these key ingredients that go into a trading strategy? Well, some of them are obviously optimal chart structure. You have reading and analyzing trends from price action. You have support and resistance. You have moving averages, and you have candlestick patterns. Yeah, just let me get a sip of water. So let's just take a look at some of these concepts in more detail. Now, the first component that we spoke about is an optimal chart structure. So what we want is we want the market to be as predictable as possible. And so what we do is we look for charts that have deliberate, even, and smooth flowing price action. And what we don't want is erratic price action. We don't want gappy charts, and we don't want charts with spiky candles. And I'll show this using examples just a couple of slides down. So, um, and even though I did talk about range trading with Nadex contracts, ideally, what we want is we want a chart that is trending. So, as I did mention earlier, my preference is obviously for charts that are trending. So, and basically just trading charts that looks like this. So if you see a chart that looks somewhat like this, we're already starting to basically stack the probabilities in our favor. So let's just talk about also charts that we don't want to trend, or charts that we want to avoid. Now here clearly there's a chart which there is no trend, and this is what is known as a typical mixed chart. So something to avoid. So even if we were range traders and we were trading ranges, so I would look at charts with a more even and more deliberate price action rather than something like this. So this is just erratic and impossible to predict. And basically the market could move in any direction. So it would go up, it would go down, it would go sideways. So a mixed chart, and better to sort of stay away from something like this. So the second thing is charts that are gappy. So, big gap here, as you can see, gap in the price action, big gap here, big gap here in the price action, and so forth. So basically, again, price movement is not consistent and it's not predictable. But the thing is, when you see gappy charts, if you move to a higher time frame, you find a much better looking trend. But obviously, this particular instance, this example, is not a chart structure that you want to be trading. Now, just one note here. You'll notice that when markets go into periods of low volume, that makes for gappy charts. So during non-cash session hours. So let's say you're talking about energy and metals here, and even though energy and metals are in theory 24-hour markets, there are specific times when you can anticipate a gappy structure. So let's say that's when the US markets close and the European markets close and the Asian markets close. So basically one market closes, the other market opens. So in these periods of transition, when one market closes and the other market opens, you will see gaps in the chart. Why? Because volumes are low, and that basically causes gappy chart structures as well. And the other thing is that some commodities, so some energies, some metals may be traded more actively or more heavily on certain markets. So like than the other, and so one needs to sort of understand the nature of the underlying and when they can be gappy to sort of differentiate them from what I call quote unquote unusual gappiness. So that's important for commodities as well. So, like I said earlier, we could of course trade this market if we went to a higher time frame, and this would potentially smooth out the price action and basically provide us a trending chart structure. So, in that case, this would of course be a long-term swing trade, and this would be less risky in that time frame. So, in that time frame, in a higher time frame, it would be less risky. So because it would be a swing trade, and the chart would not have any gaps and would not exhibit or expose itself to the risks as it would in this specific instance. So basically, it's critical in our trade strategy that we look at optimal chart structures. Now, the other thing is have look charts with candles that have long tails. So long tail here, long tail here, long tail here. So basically spiky. As you can see, this chart looks really spiky kind of a chart. And what that indicates is that there's a huge uncertainty in the market. And basically what's happening is prices are reaching for a level and they're getting rejected. Reaching for a level and getting rejected. Reaching for a level and getting rejected. And so on and so forth. And so you don't know what's the price action is quite erratic. And the other issue with trading sort of charts like this, which are spiky or with long wicks, is that if you were trading the underlying, you have a larger risk of getting stopped out, and if you were to set stops, you would have to set very wide stops. So, and that would be the case if we were trading the underlying market. But of course, with Nadex contracts, the advantage is you can trade these without the risk of getting stopped out. Nonetheless, so notwithstanding the fact that you can trade without a stop loss, I still won't trade them simply because price action is erratic and I don't know what's going to happen with the price action, and it could very well move against me just before expiry, even if I could be in the money. Let's say a couple of minutes before expiry of an Nadex contract, and then the market could suddenly move, and I'd be out with a worthless contract. So therefore, I'd sort of stay away from spiky kind of charts, and it's not really ideal market conditions. So we've spoken about what's not good. Let's look at what is good. So what is good is something like this. So here, obviously, we have a chart structure that makes the market quite predictable. So of course, in the markets, nothing is ever predictable. You can never know what's going to happen in the market, and it's a fundamental rule of trading. So, but anyway, with this kind of a chart, if you see this kind of a chart where the price action is even and deliberate, it's more predictable, and this improves the probability. And trading with this kind of a chart basically stacks the probabilities in our favor. So by trading a chart like this, we're starting by stacking the probabilities in our favor. So this is the first step. And clearly here there's a downtrend, the series of lower lows and lower highs. There's no erratic price action, so there's no extremes of buying and selling. So just even smooth flowing price action and with steady flowing momentum. So also the other thing is just notice that all the candle sizes are more or less consistent. So there's no very large candles or very small candles. So overall, basically, it's a very controlled price action and therefore an optimal chart for trading. Now, this is a bullish situation. Again, it's an optimal chart structure, and basically the characteristics of the chart is very similar to what I spoke about in the earlier slide. So again, many people at this stage would be thinking, well, this is easy. Let's move on. Uh, but let me tell you something. It's not that it's hard or anything. It's not hard, but the most important thing in trading, guys, is especially in technical trading, is trends and trend analysis. And so if one has mastered trend and one has mastered support and resistance, one has mastered about 50% of technical trading. So the other thing is, this looks and appears quite easy here, and anybody can see this this is an uptrend. But the point is, what if the trend is not as clear as in this example? A. B. What if there are conflicts? So what if you're an uptrend in one time frame and a downtrend or a no trend in another time frame? So what do we do in such a situation? So let's just take a few slides to understand trends as well. So we've gone 6 minutes past the hour. So can we take a break now? So it's 6 minutes, and let's just take a break for 4 minutes, if that's all right. So we'll be back at 4 minutes, and I've just got my little timer here, and I'll put my timer on, and so we'll take a 4 minute break instead of a 5 minute break. So I'll just start that, and when this timer goes to 1 is when we'll end our break. So thanks, guys. So let's take a break and come back. Okay, guys. So welcome back. I was just sending a reply to a question that I just got. So I was just replying to that. And let's get started. Let me just get organized here. Okay. So we were talking about price action. Let's now just talk about a little bit more detail on trends. So the first thing, and let me get this clock out of the way. So, so before we talk about reading trends, just wanted to introduce one concept, and this is the wave-like movement of prices. And so when we're looking at price, what we so when we're looking at price, we need to understand that price moves in waves. And as most of you know, price action does not move in a straight line most of the time. So even if the market is trending, it moves in waves. So each wave basically offers us an opportunity to join the trend as price pulls back to a point of equilibrium. Equilibrium being that point where price is most comfortable. So there are at least as many buyers as there are sellers at that point of time. This is a good example of that basically supply demand relationship that I spoke about earlier, working out in the price equation. So there are more buyers. The market equals that basically results in higher prices, and when there are more sellers in the market, that basically results in lower prices. So the moving averages, we use basically moving averages to identify these points of equilibrium. And so moving averages basically become a great technical tool, and we'll just talk about this 2 slides down. Before that, let's just finish our discussion on trends. Now, basically, there are three types of trends. So there's an uptrend, there's a downtrend, and there's no trend. How do you identify a trend? Well, for an uptrend, you look for a series of higher highs and higher lows. For a downtrend, you look for a series of lower lows and lower highs. And when neither of these conditions are present, you have a situation of a no trend. So how does one know when an uptrend has ended? Now, basically, it is when a series of higher highs and higher lows is broken. So this series of higher highs and higher lows right here, when this is broken, either by a higher high not being formed or by a higher low not being formed, then we have a uptrend that has ended. Now remember that a downtrend has not yet begun. So when higher high and higher low is not formed, all we know is that an uptrend has ended, right? So the exact opposite for a downtrend. So when you have a series of lower lows and lower highs, and that is broken, then a downtrend is ended, and we don't know that an uptrend has begun. So when the series of higher highs and lower lows, sorry, lower highs and lower lows, when the series of lower highs and lower lows is broken, all we know is that a downtrend has ended. We don't yet know that an uptrend has begun. So we know an uptrend has begun only when we start seeing again a series of higher highs and higher lows in the case of an uptrend, and a series of lower lows and lower highs in the case of a downtrend. So just one more thing just wanted to speak about is about conflicting trends, and we see conflicting trends across different time frames. Well, in such a situation, what we do is we don't trade, so we just sit on the timeline sidelines basically. So unless the trends are in alignment in at least 2 time frames, and so a relatively lower time frame, a relatively higher time frame, and unless we see this alignment, we basically don't trend and stay on the sidelines. At least that is what I would do. So let's talk about moving averages now. And so what are moving averages and what do they do? Well, moving averages is nothing but an average of price calculated over a certain period. So a 10 moving average is an average of price calculated over 10 periods and so on and so forth, 20 over 20 periods and so forth. So what they do is they smooth out the short-term fluctuations in price, and they help to highlight the trend for us. So in this chart, for instance, if you look at the price, there are 4 moving averages. So there's the 10, the 20, the 50, and the 200. And what they do is the 10 and the 20 give us a view of the short-term view of things. The 50 gives us a view of what's happening in the medium-term side of things, and the 200 tells us what's happening from a long-term perspective. So what we do with moving averages is we look for equilibrium zones, and I'll talk about that in the next slide. And these equilibrium zones basically highlight potential trading opportunities. And I have a question here from William, and William asks, which moving averages are best to use? Okay, this the exponential or the simple. Sorry. And the answer is it doesn't really matter at all. Either will work fine. And we can either use exponential or we can use simple, and especially the way we use them. So we don't use them in the traditional sense, and we use them as leading indicators rather than as lagging indicators. So the way we use the moving averages, you can either use the EMA or the SMA. You can use either. Choice is yours. But we use the SMA, and it works, and it works just fine. Now, different people use moving averages in different ways. So some people use them as dynamic support and resistance lines, and some people use them to generate buy or sell signals. So when a faster moving average crosses a slow moving average, like right here, it generates a buy signal, or when prices cross a moving average, as they have done right here, it generates a buy signal, and so on and so forth. Now, we don't really use them in this way. We use them in a non-traditional way. And the reason we don't is because when used in this way, they generate the signal late. So they're more of lagging indicators than leading indicators. And it looks very good on this chart. So yes, the price has just broken through and then it's gone on an uptrend. And or the prices, two moving averages have crossed and the prices have moved up. But if you notice it on real charts or on a live chart, you will see that the moving averages basically lag behind the price action. Why? Because they're an average of price action over the past. And so when this cross is generated, and the price action has actually moved on 3 or 4 candles already. So if price action would be somewhere here, is when the price cross would form, and that's obviously not a good time to be taking the trade. Why? Because there'll be a counter trend right there coming up. So we use the moving averages slightly differently. We use them as dynamic trend lines. So basically, if they're pointing up, telling us that the trend is up, and we use them to identify levels of equilibrium, which basically define our entry and exit points as well. So, so I have a question from Yehuda, who asked, "Does Nadex chart have SMA?" Yes, it does. You can just go and you can just click on the various technical analysis tools, and it'll just plot the SMAs for you. All you need to do is change the settings to change the length of these SMA. So change the settings from 10, 20, 50, and 200, and just set up your charts with these four moving averages. So I was talking about the buy zone or the sell zone or the level of equilibrium. So the level of equilibrium is what is the buy zone or the sell zone, and you see this here on these charts. So I'm highlighted in green on the left and in this bronze color on the right. And where you see the circle is where you have the moving averages pulling into the level of equilibrium, and that is where we look to make our trade entry. So for a long trade, I'll be looking to make our entry there, and that's what we call the buy zone or the sell zone or the sweet spot. And in the case of a short trade, with the chart on the right, is where you see the circles, is where I'll be looking to make my trade entry. And this level of equilibrium is where obviously there's a balance. There's a temporary balance rather between the buyers and the sellers, and prices are at more or less stable, and that makes for good sort of entry points as well. Now, let's also talk about support and resistance here. So these are probably the two most crucial elements after trends. So and a lot of people trade effectively just using trends and support and resistance as well, and trading strategies are defined just using those two as well. But let's talk about this a little bit. So what is true resistance? So true resistance is when we have two or more high touches within a few ticks at a specific price level. So right there, so there's this price level, you have high touching the price point, high touching the price point again and again. So this is obviously a level of support. And you have similarly true resistance, which is the exact inverse, and you have prices reaching down and touching and bouncing off a price level, as you have right here where the circle is, right here where the circle is, and right here where the circle is. So it's done once, twice, 3 times, and this is a level of support on the left, and sorry, this is a level of resistance on the left, and this is a level of support on the right. So, and we can actually use these levels to build a trade strategy. So of course, like I said, but we need to combine them with some of the technical factors, and that's how we stack the probabilities in our favor. Now, one thing about support and resistance, they are a leading indicator of price. Why? Simply because we know what price to buy and sell before the price even gets there. So if you're expecting prices to come back to this level of resistance, say, and the prices are moving up from here, so we know that this would be a profit target right here where I'm hovering my mouse right now. So one important point I just like to point out is that when support gets broken, it becomes resistance, and when resistance gets broken, it becomes support. And this happens again and again and again with unfailing regularity in the market. So here you see this level of this line, so 101, which is also a round number. And you see that this level was acting as resistance on the left where I'm hovering my mouse, and then it got broken. And then after it got broken, it's now acting as support. So support becoming resistance and resistance becoming support is something that you'll see again and again and again with unfailing regularity in all the markets. And why does this happen? Well, basically because the market has memory. So what traders do is they have entry orders waiting in the vicinity of these levels, and when prices basically reach for these levels, these entry orders get triggered, and that either causes a reaction away from the level or it causes a break through the level with quite a lot of force, as you can see here. And that actually we can use this fact to create multiple trading opportunities as well. So we've looked at different technical factors that comprise the trade strategy. So now let's start putting all this together into okay. So let's start putting this together into some form of a technical trading strategy. Okay, so all right, I know I've just got some feedback saying that I'm going a little bit too fast and that I need to slow down. It's just that um, we've got quite a lot of material to cover, and I'd like to actually go through and complete all the material in the time that we have. So yeah, my apologies. I will try and slow down a bit, but then I need to be mindful of the fact that we have to cover all the material that we need to as well. Now, so I spoke about the trend flow strategy earlier, and the thing about the trend flow strategy here, and I've basically listed out the checklist or the strategy in itself, and I'll just sort of go through this quickly. So first and foremost, what are we looking for? We're looking for an optimal chart structure, like I said earlier. So we're looking for predictable price action. Then what we want to see is if there's a trend and what is its direction. Third, we want to check for moving average geometry, and are the moving averages aligned in the correct order. So is the 10 above the 20 above the 50, and the 50 above the 200, and is there good separation between them? Then we want to see if prices pull back to the buy zone or the sell zone between the 10 and the 20 moving averages. And for our entry, we want to see if there's a small bullish or bearish candle that is formed, depending on whether we're going long or whether we're going short. So next, of course, we want to examine the possibility of at least a 1:1 reward to risk scenario. And ideally, we would like our entry to be just slightly above or below a support and resistance level. So there you have it, guys. The sum and substance of the trend flow strategy. So there is actually one more strategy that we teach, and that's based on the breakouts that I spoke about when I was talking about support and resistance. Now, let's walk through a strategy setup here. So let's use some charts and let's see how the trend flow strategy actually sets up on the charts. So here's a chart of copper, and this is a 4-hour chart, so 240-minute chart. And we have a nice trend in place, so higher highs and higher lows. And the moving averages are in order, and there's good geometry between them. They're pointing up, and there's good separation between them as well. Now, what we don't have on this chart, we don't have the indicators to check for convergence or divergence. So we don't have the MACD or the RSI plotted, but let's just assume that they are convergent. So also, the thing is, as we actually scan our charts, what we want to be looking at when we do look at the historical charts is we want to look and see if there are trade setups that are similar in the historical charts. And basically what this does is this confirms for us whether the trade setup that we're looking at does occur on the chart with some regularity, and if it does, therefore that means it's got a higher probability of repeating. So as I've been saying all along, trading is all about stacking the probabilities in your favor, and this is one of the ways to do it. So, okay, so we found a good trending chart of copper, and it was trending on the 4-hour time frame. But what we need to do is we need to look at the next higher and the next lower time frame as well. So to see how the price is behaving across multiple time frames and multiple charts. So I just want to highlight that it's actually very good practice to just plan on always looking at charts, several charts, and several charts that surround the trade setup chart. So and that gives obviously us a better idea as to what's happening with price. So now we have the same chart structure here. So it's in an uptrend. Moving averages are the correct order. A good separation between the moving averages. So moving average geometry is quite good, and we have a series of higher highs and higher lows. So we have good solid trend confirmation, right? And we can clearly see there's a prior resistance level, so right there. So that resistance level is now acting as support right here. So we have a small bullish candle in the buy zone, so right here, small bullish candle in the buy zone, and we also have a consolidation of bullish candles in the buy zone. So this is a positive sign, guys, because what this does, because a confluence of small candles rather, indicates that this counter trend is about to end and the trend is about to take off again. So small candles and a series of small indecisive candles usually indicate an imminent change in direction. And in this instance, there was a counter trend which is pulled back to this level of support and into the moving average buy zone, and it's likely that it's going to bounce off this and go on its merry way. And also, as you can see here, there's a small bullish candle that's formed, that's broken the high formed by these small 3 or small 4 indecisive candles right there. So currently we are at 3.156, and let's take a look at what Nadex contracts are available to trade at this level. So before we look at the contracts, of course, there's just one more piece of information that we can add to the mix, and so I've drawn out the Fibonacci levels, and we can see that there's a retracement from the 3.18 level down to the current price level, or where the resistance level exactly is. So that's a 50% retracement right there. So this is the move where I'm hovering my mouse right now, and this is the retracement, and the retracement is a 50% retracement, and the 50% retracement is exactly equal to where the level of support resistance is. So that adds another layer of confirmation to our trade. And we are just now stacking the probabilities in our favor. So one after one after one, we're stacking the probabilities in the favor. So first we had a trend. We saw that the trend was good on multiple time frames. We saw that there's a level of support and resistance. We saw the prices are bouncing off that level of support and resistance. And now we see there's a fib level as well. So now we've added one layer after another after another. And this is what I meant when I was talking about adding multiple layers of confirmation to your trade. So having done that, now that we've got a bullish bias, let's look at what our options are using the various Nadex contracts. So obviously what we want to be doing is we want to be trading or making a trade entry at about a 3.156 level, and with a target at or below the 3.18 level, which was the previous swing high. So if you look at the Nadex contracts, there's two options available. So there's one with a strike of 3.160 right there, which is highlighted in green, so not very clear, and the other one is 3.18. So we could buy either of these two contracts, but the other thing that we need to look at now is also the time left to expiry. So the thing is that both these 3.16 and 3.18 contracts are not yet in the money, so they're still out of the money. So we need to see how it's going to play out and how we can put time, basically we can put the time decay on our side. Now there's 16 hours remaining, but if you look at and so let's look at how long it took for this retracement to occur from 3.18 down to 3.16. As you can see, it's like 1, 2, 3, 4, 5, 6. So 6 candles. It took 6 candles to retrace from there right down to the 50% level. So, and there's a 2-hour chart, so that's 6 times 2. So it took 12 hours for this to play out. Now, there's 16 hours left to expiry, and we're looking at making an entry at 3.18 or 3.16. So that obviously makes sense. So 16 hours left. So it took 12 hours for this move to happen. So it's likely that in the next 12 hours, prices will move up and retest this 3.18 level. So we could make an entry using an either Nadex contract using 3.16 if you wanted to be conservative, or 3.18, or if you wanted to be more aggressive. Or of course, what one could do is, you could break your total trade size up. So you could trade maybe, let's say, 1 or 2 contracts of this, or 1 or 2 contracts of this, or work on 1 contract of each, depending of course on your capital outlay. And what that would do is, that would sort of balance your trade out in terms of one high risk trade and one sort of more conservative trade. And also the other thing that we need to be talking about, and I'll talk about that a little bit in the next few slides, is about how to manage the trade, and basically managing our trade so we break even, and we break even and exit at break even, and I'll talk about that a couple of slides down. So another setup here. This is a short setup, and this is a natural gas, and this is again a 4-hour chart. So we've identified our downtrend here, and um, so prices are obviously moving down. Moving averages of good geometry. They're in the right order, and they're fanning with good separation between them, good downtrend, and prices are pulling back, as we see here, into the sell zone. And there are obviously entry opportunities to join the downtrend at these points where I'm hovering my mouse. So what we obviously need to do is, this is a 240-minute chart, so we want to look at time frames, one time frame down and one time frame up, to see how price is behaving on those time frames as well. And so this is the 2-hour chart, and in the 2-hour chart, again we see that prices are in a downtrend. Moving averages are in the right order. There's good separation between them, and prices are moving into the buy zone and pulling away. And also we see here that you have a candle forming, which has just broken the entry or the trigger candle, and this would have been my trigger candle, and just broken that. So this would be a good trade to the downside, and that tells me this is, the downtrend is likely to continue based on the fact that this candle has broken the low of this trigger candle where I'm hovering my mouse right now. Now, this is the same chart as before. This is a 2-hour, so this is a 2-hour natural gas chart. So let's just look at what options we have in terms of binary spreads. And I'm just going to use this example to demonstrate binary spreads. To demonstrate spreads instead of binaries, not binary spreads. So demonstrate spreads instead of binaries. So here we have again 2 options. So here we have spreads with a ceiling of 4.4 and a ceiling of 4.65. So we could consider either of these 2 contracts, so the 4.4 ceiling contract or the 4.65 ceiling contract, and we could use either of these in with respect to our trading. So currently it's the price is trading at 4.37. So if we went with the 4.65 contract, well, we could do that, but what it is that the 4.40, the contract with the ceiling at 4.40, so this 3.9 to 4.40 contract basically gives us a much better reward to risk situation. So if you went with this contract, for instance, the 4.65 contract, our potential reward would be like 22 pips. But if we went with the 4.40, which would be $22, and in this contract, the 3.9 4.40 contract, our potential profit could be $47. So much better risk to reward ratio with this contract here. And the thing is that when we enter the contract, enter the order in the order ticket on the Nadex platform, and this is important, guys. It will the order ticket actually always tells you what your maximum loss or your maximum profit is. So on the left bottom of the order ticket, you always see your maximum loss, and on the right bottom of the chart, you'll see your maximum profit. Okay. Now let's talk about. So we've talked quite a bit about technical trading strategy, and we've talked about how to apply the ingredients of technical strategy and how to apply technical strategy to trading binaries and spreads. Let's talk a little bit now about some fundamental trading strategies. So fundamental trading, as I said earlier, is basically trading using non-price related factors which drive or influence the price of the underlying. So now, for instance, one of the things that how we can trade fundamentally or using fundamental factors is we can do what is known as news trading, which I just alluded to earlier in my presentation. So um, we now the thing is with any commodity, especially with like let's say energies or metal futures, you have news coming out every now and then, and we don't know now the news, what the news will be, because of course if we did that, then that would be insider trading. But so we don't know what it is, and but what we don't need to know, and why? Because we can trade the news using a Nadex binary. And why? How? Because it's a fixed contract, and it's a fixed contract with no stop loss. And we'll see this in some of the examples. Just 2 or 3 slides down, we'll take some examples to see how this actually plays out. So remember, with Nadex contracts, especially with Nadex binaries, the biggest beauty is that you can, it allows you to get to a trade and get into a trade with a limited downside risk without a traditional stop loss. And this is a fact that we can employ to trade the news effectively. So what happens when there's a news event? So the news event basically gives us a precise timing for contract selection. So when the news is going to come out is when we is the so that we the contract that we select rather is based on when the news is likely to come out. So we select a contract with an expiry just a little after the news event actually occurs, or the news is actually released. So using these binary contracts, so we can basically take either a directional trade or a directionless trade, and I'll just talk about that. So basically, the other thing that we need to understand is we need to understand how the news event that's coming out, how that sort of impacts the underlying market, and I'll just talk about that in the next slide. So I spoke about directionless trade, and I'm going to focus more in this webinar on direction-based news trading rather than directionless trades. The only difference with directionless trades, guys, is basically you obviously assess your reward to risk, and what you do is you have both a long and a short position open simultaneously, and but with a little bit of a bias to either direction, based obviously on your understanding and analysis of the market. Now, I just spoke in the earlier slide about understanding the news. So the first thing, of course, is one needs to have an economic calendar, and there are several websites. It's all free on the web, and you can just go on these websites, and all of them have an economic calendar which tells you specifically when news relating to what event is going to come out, and the news is released specifically exactly at that particular time. Now, the other thing is what is important here is there's a few things to sort of understand. So the first thing is one needs to have a grasp of the typical market reaction to specific news events. So when the news, for instance, when the news exceeds, when it meets, or when it fails to meet the anticipated forecast. So there is an anticipated forecast, which is put out by economists or specialists in the field. And when the news comes out, depending on where the news stands with respect to the forecast, prices behave accordingly. So this is basically what causes the reaction in price. So if the news meets the forecast, then basically most, like 9 times out of 10, the market will do nothing. Now, if the news exceeds the forecast, or specifically in a market like, let's say, crude oil or natural gas, where the numbers are released, are supply numbers which are released every week. So if the supply exceeds forecast, then prices will basically rise. Now, if typically you'll also see price of energy commodities pull back into the moving averages just ahead of the news release. So just before the news release, prices go into moving averages, which means they go into a level of equilibrium, and just prior to the release. And this happens with unfailing regularity when energy supply numbers are released on a weekly basis. So in terms of contract selection, just ahead of a news announcement. So as I mentioned, a news trade is basically based on an impending event at a given time. So what this means is that we can take advantage of shorter term contracts, and since these shorter contracts have less time until expiry, they actually move a lot faster. But you can still trade a longer contract if you so wish. So just be aware though of the time value element. So normally this will be an intraday sort of type of setup. Now, uh, we talked about the calendar of events, even when, and for basically for oil and gas, this happens every week. Uh, and this happens every week on the mornings of Wednesday and Thursday. So basically what happens is at I think 10 half past the hour, so at 9:30 on every Wednesday and every Thursday, the oil and gas weekly supply figures are released. So if you decide to trade the shortest contract on a news trade, then basically you'll be looking at the 30-minute contract. Why? Because the news is released 30 minutes past the hour. So basically what you want to do is you want to get your trade in the system, and you want to get your trade in the system around 15 minutes ahead of the news. So, and I'll talk about why you want to get your trade in ahead of the news as well. Well, so now the third thing and the final component of trading the news, so is basically trade management. So the first thing, obviously, so there are three components that we spoke about. One is identifying the setup on the chart, knowing your targets, so knowing what should be your entry, how much the move will be, what is the profit target. B, knowing when the news is going to come out and understanding how the news impacts the underlying market. So how the news impacts the underlying, let's say, announcement related to gold or announcement related to natural gas or oil or what have you. So how it impacts it and how much the price is likely to move. And the final component is managing the trade once you've done that. So obviously when the news is released, you'll see that prices become very volatile. So this means basically potentially large swings of prices, and that make it quite difficult to follow. So, and with oil, for instance, or energy, supply numbers are not going to change again until the following week. So what so the probability of a quick reversal is not likely. But another important fact to note is that it's important that the market may still respond technically. So for instance, if there's a large spike in price, that may still respond to a technical overextension from the moving averages. So let's say the prices were overextended from the moving averages, and the news is released, and there's a large spike that is formed because of the news. But because of this overextension from the moving averages, prices will, in all likelihood, pull back to this moving averages within a reasonable period of time. So one needs to recognize this fact as well when trading the news. So the other thing is when trading any kind of news event, so like I said, it's essential, it's very important to plan ahead and to plan your profit targets. And how one trades news events is basically using limit orders. So it's important to enter the limit orders already into the Nadex platform, and because the price action is very fast when the news is released, and it's almost impossible to get to your mouse quickly enough and just click on it and make an exit. It's by the time you've clicked, the market has moved on. So what one needs to do is plan the trade and then have limit orders waiting in the Nadex system. So when price hits certain level, those orders are automatically executed. And that's very, very important when trading news events, because of the speed at which things move when the news is released. Now, uh, so what are some of the technical factors that one would look at when trading the news? Well, I spoke of overextension just now. So obviously overextension. So the price is overextended from the moving averages. It's likely that they will snap back. Second thing that we would look at is we'd look at the indicators. So I'd look at, like, let's say, the MACD and the RSI, and I'd look at whether they are convergent or divergent across several time frames. And I'd also look at how prices are behaving with respect to key support and resistance level, especially for my exit point. So once the news is released, then basically again, you can go back to using your technicals and to determine the movement price. But because at the point the news is released, the biggest driving factor, biggest determinant of price is going to be the news. So one needs to combine both the technical aspects as well as the news impact itself. So let's look at some examples of news trades, and we have natural gas charts here. Uh, Okay, I have a question from Clifton on limit order. Clifton, I'll just come back to that at the end of the webinar if you don't mind, because what I don't want to do is I just want to go through the material and take the flow. And I'll explain what a limit order is. Essentially, a limit order, what it is just setting up an order on the Nadex platform with a predetermined price level. So you go in, you set the price at which you want to enter into a trade, and you just set that up. And in Nadex, actually, all the order tickets are basically limit orders. So there's no such thing as a market order in Nadex on the Nadex platform, because you actually need to enter the order price, or the price at which you want to enter the trade. So you're setting that. So when you're setting that, that's what is known as a limit order. Anyway, so we're looking at some examples of news trades on gas and oil. So we have natural gas charts here. So on the left you have a 8-hour chart, and we see both on the 8-hour. So you have the daily chart on the left, and you have the 8-hour chart on the right. And on both charts we see nice uptrend with the moving averages in the right order, and they're all pointing up. There's reasonably good separation of moving averages in both charts. So basically our bias in this case is bullish. Now the thing is, in the daily chart, the trigger candle and the setup candle is nice, is small and bullish. However, on the hourly chart, on the 8-hour chart, it's quite large. And so what we want to do is what we I would, if I was trading the underlying, I would not necessarily be trading of this 8-hour chart where I'm hovering my mouse right now. So having identified the setup, I would actually then go down into the lower time frames, and I would look at the 4-hour and the 2-hour charts, for instance, to take an entry with a limited risk. But since we are trading Nadex contracts, and we don't need to trade with the traditional stop loss, so our risk is fixed, so we can trade this chart. So coming back to what I mentioned earlier, so just prior to an important news announcement, you can see that price is pulling back in this case. So prices are pulled back into the equilibrium level, and between the 10 and the 20 moving averages. And basically what they're doing is they're waiting for the news to break. Now this is typical. This is typical across all markets, and it basically simply suggests that basically prices have reached an equilibrium point, and there are as many buyers as there are sellers, and they're just all waiting for the news to break. Now, though this example again is about trading the news, but as a technical analyst, one might see trend flow setup as well here. So you may have both a technical bias as well as a fundamental bias for this trade. So again, coming back to the example, so the current price is trading at 4.615, and we see that the swing high here in this chart is at 4.70. So here or here is 4.70. So that's where we have the swing high. Now, so let's look at how we would select a contract and how we would place our trade on Nadex. So the price, as I said, is 4.615, and we look at contracts with different expiries. So we're looking at two binaries with different expiries. We're looking at one with 4.65 expiry, and we have one with 4.75 expiry. Note the prices are very different. So the prices for the one with the 4.65 expiry is $43. The price for the one with the 4.75 expiry is $19. So, and the thing is, with binaries, again, you'll have expiries. So it's trading currently at 4.615, right? And with binaries, you'll have binaries which are much deeper out of the money. So this one's for the 4.65 expiry is out of the money. 4.75 is deeper out of the money. And if you don't understand these concepts of in the money, out of the money, then I'd encourage you to come to the Introduction to Binaries webinar, where we actually explain these terms and talk a little bit more detail of what that means. But and so if you had one with say 4.85, that would be even deeper out of the money, which means basically all that means is that the price at where the underlying is trading now with respect to the strike price, it's basically below the strike price. Or that's so if you're going long in a long situation, it means that the underlying is trading at a price below the strike price of the contract, and that basically means the contract is out of the money in a long situation. So and with binaries, the thing is you'll always find cheap contracts with fantastic risk reward scenarios. But what we need to do is we need to use some discipline in our contract selection. So what we need to look for is trades with, let's say, 2:1 or 3:1, or at least of course at least a minimum 1:1 risk reward scenario, and that's quite profitable, and that's quite respectable. Sorry. And obviously profitable. So what we don't need is, like, a 10:1 risk reward situation. And yes, sometimes the situations are available. So in theory they're available, but what you want to remember is that the further your strike price is from where the market is currently trading, the less likely it is to be reached within the expiry time frame. Of course, given the time frame, and like we saw in the previous example where we worked out, the time frame for the market to move in a certain direction, and you use apply the same time frame calculation to see how much the market is going to move in the direction of your trade, in the direction that you are saying that the trade is going to happen. So basically, the idea is to keep the strikes as close as possible while while taking a risk reward situation which is at least 1:1. So 2:1 is fine, 3:1 better, but riskier. And obviously, the idea is to take the closest possible strike price to where the market is currently trading. Of course, if you're going long and you're out of the money, um, and with provided it meets those risk reward characteristics. Or, like I said earlier in the earlier example, you could buy one riskier option and one option that was more conservative, and you could spread out your risk that way as well. So here, we have 4.65, which is comfortable, 4.75, which is a bit riskier, but obviously cheaper because it's trading at $19. So, I personally wouldn't be interested in a strike beyond the swing high, since I have a much closer strike, and so much better risk to reward situation. So let's look at what happened in this trade. So as we said earlier, so the price, basically, if you had bought the 4.65 trade, then we would have ended up with a profit, and would have ended up profit um, because it obviously closed above the 4.65, or we could have closed the trade out using a limit order, and we could have sold it at $88 when prices reached up into the 4.7 mark. And as you can see here, 88. So the 1-to-1 target is met in the 4.65 contract, whereas in the 4.75 contract, we bought at 22.50 and would have sell at 22.50. So essentially, we would have broken even, not really making a profit. The other thing to note also, guys, is the fact that yeah, when we're trading the news and we get into a trade, so suppose, for instance, it's important to close out half a position. So if you entered with two contracts, so it's important to close out one contract when the trade breaks even. So in this instance, so let's say we entered with, let's say we went with the 4.65 contract and we bought it at $43. So, when the prices of the contract went to $86, I personally, for instance, I would close out one contract, and what that would do is basically that would make my trade break even. So I would recover, I'd bought two contracts, right? So $43 each times 286. And once, the market, and then the price of the Nadex contract went to 86 at the release of the news. So I'd sell one contract. That means I'd realize $86. So essentially the trade for me would be free. And then what I would do is I would take the other contract and I would just ride that out all the way to expiry. And knowing that, I have nothing to lose on the trade. And so this way, what I'm doing is I'm allowing myself the sort of luxury of being able to ride the market and protecting my downside risk at the same time. And that's a very important thing to do, obviously, when trading any contract, especially when trading binaries. And this is what I meant by when I was talking about managing the trade. So it's important to break even first, and once you've broken even, then you can basically ride out the balance of your contracts all the way to expiry, with very little risk. Of course, if the contract went to the, say, 97, 98 level, 95, 96 level, I would, for instance, and there was, some time to expiry left, I would actually look at closing my position out as well. Why? Because as binaries get closer and closer to expiry, and especially if they're trading at or around their strikes, so if they're straddling their strikes, and the binaries are exposing, and the binaries are approaching expiry, they become very volatile and they go swing, boom, boom, up, 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 down, up, down. So if I was like sort of in the money and my contract was, let's say, 97, 98, and let's say there were 7-8 minutes left to expiry, so I'd close my position out and I'd walk away. And that's the way I trade it. So here's another example, and this is an example on crude, and this is just minutes prior to the supply numbers coming out. So technically we have a solid uptrend, as we can see here, and we have prices pulling back into the buy zone, and price is currently at 103.9. So it's solid uptrend, good chart, and this is the chart is of the 8 hour, the same thing in the 8 hours. So what we're looking to do is, obviously, we're looking to trade this chart long, and in most circumstances, and news is, let's say, about to come out in the next couple of minutes. So if there was a situation, if news were about to come out, and if I saw this chart and it's probably an ideal trend flow long chart, I wouldn't actually trade it with the underlying, if I was trading the underlying market. Why? Because there could be wild swings right here, and I don't know what's going to happen. But with Nadex contracts, I know I can trade without a stop loss, and therefore I'd be looking to enter, even take a trend flow entry, but I can take a trend flow entry, and in this case, I can probably use the news as a kicker. So if the trade goes in my direction, along with the news, so there's a trend, so I'm entering in the direction of the trend. So using the trend flow, and I'm using the news as a kicker, will just help my trade along in the direction that I want. So this is another, so same trade, and this is another time frame, and we see this is the 4 hour time frame, and we see quite a good setup here. So the moving average is in a good order, in the correct order, and they're fanning, and prices have just broken the high of this candle here, so making for a good long entry right there using the trend flow strategy. Now, And the thing is, and I'm just using this for demonstration purposes. So I'm looking at the weekly charts here. Why the weekly? Even though I'm trading the news, well, because I'm looking at, like I said earlier, looking at this as a trend flow setup with the news as a kicker to help my trade along. And I have two options using the weekly. So I can either go for the 104.25 strike price or 105.25 strike price. Remember, the market was trading at around 103.9, and there was a swing high. There was a swing high at 104.5. So swing high just slightly above this strike and below this strike. And there's 2 days to expiry. The news is coming out in a few minutes. So if the trade doesn't play out as per the news, then I can always trade this as a trend flow setup as well. And that's the logic that I'm using to use a weekly chart to take this trade. Now, I wouldn't look at 105.25 strike price. Why? Because it's way above the swing high. So the previous swing high is 104.5, and because the previous swing high is 104.5, that's all I'm interested in. That's what I'm looking at the moment. So I would trade it at 104.25 strike, and as you can see, the price is 42.5. So better than 1:1 risk to reward ratio. So I'd get a risk to reward ratio at about, let's say, 1.5:1 by trading this. So decent risk to reward ratio, and a much safer option as regards trading. So the 104.25 big. Why? Because it's below the previous swing high. So let's look at what happened in the trade. So as the trade played out, we see that it went and actually hit had we traded the 104.25, we would have the trade would have been profitable, and we would have made a profit of $175.5. But if we played 105.25 and we'd taken that trade, then we would not be at profit. Of course, there's still time for the trade left, so there's still 2 hours and 47 minutes. So unless in the next 2 hours and 47 minutes this trade moves to 105, then this particular trade, having taken 105.25, would have ended up in a loss instead of in a profit. So let's just talk briefly about how you can take your trading further with Nadex. So some of the benefits of trading Nadex contracts we already spoke about. So binary options and spreads are fixed risk, and some of the facts, and we saw how to do this, is how we can use flat markets, sideways markets, and we can profit from these as well. And there are several range of markets to trade with Nadex contracts. Some of the benefits we spoke about is that there are contracts with different time frames. Transaction costs are low, so it's 0.9, it's 90 cents per contract per trip. So for a buy and sell, it's actually $1.80 per contract, and it's capped, though it's capped at $9 per order or per lot. And obviously, since Nadex is a US-based exchange regulated completely by CFTC, and you get all the support that is provided to all the traders through Nadex, and such as programs from Trade with Precision. So educational sessions, in addition to sessions such as today, there's the advanced strategies course that I spoke about, and of course it's completely free for all Nadex members. So let me give you some details about that if you're interested. There's no cost to you, and it's all sponsored by Nadex. So the advanced trading program is a 4.5 hour program where we discuss our strategies, and basically we do live trading as well. This program is valued about $900, but it's entirely free for Nadex clients. And there's a couple of different ways for you to get in touch with us. So you can phone us, you can email us, and of course there's 14-day demo accounts for you to trade, paper trade if you so wish. And if you're a Nadex member, you can receive the advanced education package provided by Trade with Precision. That's free of cost to you. So for those of you who are Nadex members and have not been very active, so if you'd like to begin trading again, just log into Nadex and take a look at the education tab for some instructional videos on both binary options and spreads. And we're actually adding to that library monthly, and there are some tools that can really help you. So however, if you're new, then please set up an account with Nadex and visit nadex.com and enter your details using the sign up icon, and someone from Nadex will respond by email to get you started. So that basically brings us to the end of today's webinar, guys. It's been a great it's been a great privilege and pleasure talking to you guys, and some of the levels of questions that have been there today have been excellent. So I understand that this is a very knowledgeable crowd, and unfortunately we don't have a lot of time left for a lot of questions. But thank you for 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 your time today, and thank you for everything. So there'll be a short survey just at the end when you sign out. So please just take a couple of minutes of your time. It just takes a few minutes. Just fill it out and please send it back. So because we get feedback based on that, and based on that we know how to improve. So thank you, guys. And I know there's a lot of people here today, so I might have missed a few questions here and there. And if I did so, apologies. But you can always email your questions through, and we'll look at that and we'll get back to you with an appropriate answer. So thank you, everybody. Thank you, and good night.